G'day, welcome to this explainer. Today, we're cracking wide open the HSC Business Studies Finance syllabus. And to do it, we're looking at the real-world numbers behind an absolute global fast food giant. To really wrap our heads around financial management on a massive scale, we're diving straight into Yum Brand's 2022 annual report. You know them. They're the empire behind KFC, Taco Bell, and Pizza Hut. We're talking over 55,000 restaurants across more than 155 countries. Managing the cash for a beast this size, well, it's the ultimate test of business finance, making it the perfect real-world example to lock in those crucial syllabus concepts. Here's our roadmap for today. We'll be stepping through the core pillars of the syllabus, starting with the role of finance, then key financial influences, moving into processes and ratios, looking at effective financial strategies, and finally, wrapping up with unlocking opportunity and growth. Let's rip into it. All right, Section 1, the role of finance. Let's look at what finance actually does for a business on both a daily and a long-term basis. Look, the strategic role of financial management isn't just counting beans or ticking boxes, right? It's the absolutely vital process of planning, organizing, and controlling financial resources so the business can actually operate, grow, and hit its long-term goals. For Yum Brands, this strategic engine ensures they can confidently fund their global recipe for good growth vision for the long haul, rather than just stressing over whether they can afford tomorrow's batch of potatoes. And that right there creates a fair dinkum balancing act. You've got this classic conflict between short-term and long-term objectives. See, a business has to pay its daily bills, meaning it needs to effectively manage its short-term liquidity and efficiency. But at the exact same time, it's aiming for those big picture goals: profitability, global expansion, and solvency. Let's say you spend a ton of cash today on a massive digital upgrade across thousands of stores. Well, that might take a serious chunk out of your short-term liquidity, but it's absolutely essential if you want to secure long-term growth and stay ahead of the pack. This balancing act brilliantly highlights the interdependence of key business functions. You see, finance doesn't just operate in a vacuum. It relies heavily on marketing to actually generate the sales, while marketing desperately needs finance to set the budgets for their massive global campaigns. Just look at how Yum allocates funds to operations to roll out Pizza Hut's AI technology, or to human resources to fund essential employee training across 27,000 KFCs. Literally, every single function relies on finance to do its job, and ultimately to maximize that bottom line profitability. Moving right along to Section 2, key financial influences. We really need to understand the internal and external forces that dictate how a giant like Yum manages its money. So you might be wondering, who actually keeps these massive multinational corporations in check when they operate on our shores? Because they certainly can't just write their own rule book and do whatever they want with their cash flows. Well, those influences come from both strict government regulations and pretty volatile global markets. Here in Australia, ASIC, that's the Australian Securities and Investments Commission, enforces the Corporations Act. That ensures transparent financial reporting to protect everyday consumers and investors like you and me. But on top of standard company taxation, Yum is also at the absolute mercy of global factors. Shifting world interest rates and the overall global economic outlook directly impact exactly how and where they source their capital, and just how aggressively they can plan for future expansion. And that brings us to a crucial decision. How do they actually get that capital? When Yum or its franchisees need cash to open new restaurants, they've got to carefully weigh up taking on debt versus raising equity. Now, debt financing means borrowed funds. The interest payments are tax deductible, which is great, but you are legally obligated to pay it all back, regardless of what your cash flow is doing. Equity financing, on the other hand, involves selling shares on markets like the ASIC. There's no interest to pay back, sure, but it dilutes your ownership, and suddenly, you're completely accountable to a board of shareholders who are expecting regular dividends. All right, time for the hard yakka. Section 3, processes and financial ratios. Let's look at the actual tools used to monitor and control the cash. Before we start crunching the numbers, you've got to remember these two vital definitions from the syllabus. Liquidity is the ability to pay your short-term debts using your current assets. Solvency, on the flip side, is your ability to meet overall long-term financial obligations. These two concepts alone literally determine if a business survives a sudden, short-term cash crunch or if it can successfully weather a prolonged, multi-year economic downturn. So looking at comparative ratio analysis in action, using Yum's real financial statements from 2022 versus 2021, a pretty clear story emerges. Check this out. You can see a solid jump in total revenues to nearly $6.8 billion. But did you notice the net income? It actually took a slight dip, dropping 16% down to $1.3 billion in 2022. This tells financial managers that even though total sales grew, rising operational expenses, or maybe other external factors, ended up eating into that final profit margin. Now, to figure out exactly what is eating into those profits, financial managers apply specific mathematical formulas to their income statements and balance sheets. They use the current ratio to check liquidity, the debt-to-equity ratio to monitor gearing and long-term risk, net profit to sales for pure profitability, and the expense ratio to gauge operational efficiency. By consistently comparing these ratios over time and stacking them up against industry standards, they can pinpoint exactly where the business is leaking money. So, how does a massive empire actually execute strategies to fix those leaks and improve their financial ratios? Let's get into Section 4, Effective Financial Strategies. Honestly, it all comes down to working capital management. By carefully controlling current assets, like their actual cash on hand and massive, fast-moving food inventories, and balancing current liabilities, like payables to suppliers, management makes sure they never run out of operating cash. They also use clever strategies, like leasing delivery vehicles or kitchen equipment instead of buying them outright. It's a simple move, but it preserves that vital upfront capital for other high-yield investments. $24 billion. That was Yum's global digital sales in 2022 alone. And get this, that number has effectively doubled since 2019. It is a staggering figure that highlights exactly where their strategic focus lies. This explosive digital growth absolutely proves how investing heavily in revenue controls and cutting-edge technology radically improves both efficiency and the bottom line. Whether it's funding Taco Bell's proprietary vertical lift for those frictionless drive-thrus or implementing Pizza Hut's Dragontail AI to completely optimize delivery routes, these massive capital expenditures are carefully modeled and planned out by the finance team. They do this to ensure that profitability just keeps growing year after year. Let's move to our final section, Section 5, Unlocking Opportunity and Growth, and see how financial management also carries a pretty hefty social and ethical responsibility. In today's global market, ethical financial reporting and social responsibility literally go hand in hand with making money. In fact, the syllabus actively requires us to understand management's ethical responsibilities. A prime example here is Yum's strategic drive towards gender parity. They've been actively funding initiatives and corporate structures that have led to 42% of global senior leadership positions now being held by women. Modern finance just isn't about solely maximizing shareholder dividends anymore. Yum is consciously allocating $50 million to social impact programs. They're investing in green technology to realistically reduce greenhouse gas emissions by 46% by 2030, and funding massive supply chain overhauls to strip out artificial colors and flavors globally. It's what we call the triple bottom line in action, caring for the people, the food, and the planet, all while staying highly profitable. So I'm going to leave you with this question to chew on. If you were managing the finances of a 55,000 restaurant empire, how would you balance the relentless drive for short-term profitability with the long-term cost of a sustainable planet? Financial management really is the ultimate balancing act of raw numbers and everyday ethics. Keep these concepts in mind next time you grab a feed. Thanks for joining me on this explainer. Catch you next time.